So if you've ever been wondering what is the best decision to invest in regarding property versus stocks, this is the Young Money Hackers podcast. I'm Charlie and this is Handel, and we're going to dive in and unpack the relative comparison between what might be best for you, property versus stocks. Let's get
exactly right. And we're going to look at what makes property a good investment, and maybe we'll look at some of the reasons why stocks could be a good investment as well. We're of the stance that property is better, and we are part of this very heated debate. But it's just about, I guess, going through the numbers and seeing what it says for us. But I don't know. Let's start off the general conversation, right? So, why do we think property is better, Charlie, right now?
Well, I think property has experienced a less volatile growth curve over the years, and it provides us more options in terms of that, providing a passive income. I like to use that term, passive income, but it does, and it's worked for me a lot sooner than you might get with stocks. And what I think is that there's opportunities for everyone with investing, whether it be stocks or property, but there's a time and a place for both. And I think that if you know what you're doing with property, you can get results that will outperform stocks. Yeah. And there's opportunities in terms of buying at the right time, capitalizing on capital growth fast if you know where to buy and you know what you're doing. And you also get the benefits of leverage, which you can do with stocks, but it's usually not the best idea for the everyday person. But with, banks like lending to us when we're buying property. They always have, they always will. So that's a benefit that we can take advantage of.
Yeah, exactly right. You mentioned a pretty interesting word, leverage. So for those people that don't know what leverage is, I think a lot of what you've explained was quite self-explanatory, but leverage, what is leverage and why is that of benefit for properties, you think?
Yeah, well, leverage is basically using other resources to accelerate your position. And in the context of property, we're leveraging other people's money. So we're using the bank's money to buy an asset that is a lot larger. We're getting a lot more control over a larger asset a lot quicker. And we can use that to our advantage. We can use that to, accelerate our property portfolio if we want to do that.
That's right. And with leverage, so you're really referring to debt. But what if people are scared of paying debt or having debt?
I think debt is part of the process. I think for people that are really scared of debt, just look at the income, look at the growth over time. And as long as you're in a good position, like your LVR isn't too high, I think debt's a good part of it. What are your thoughts?
Yeah, exactly. Even if you just do the calculation up front, I think debt leverage, I think, is probably on your side than anyone else's side. So we're looking at, to over some of the tougher times in the past, banks have, and the debt has been actually quite friendly to people who has been using them. So during COVID, there were some deferrals on payments and things like that. For those of you who can sort of explain what's going on, more times than not, the government is going to protect you, because people who seek debt, especially like around property, not on personal, but on property and things like that, it's actually the government is quite protective of that, because that is the backbone of their economy, and people know it. So. And with debt, it is a great position to be in. So let's say you buy $100,000 home that generates, $6,000 a year in income. And your debt position is, let's say, $4,500 a year, like in terms of paying debt, right? Obviously, there are no $4,500 debts these days, because, the rates are sitting at $5,500. That's a percent. And on percentage of 100,000, that's about the amount that you'll pay. So you're getting paid $6,000 a year in rent, then you can actually cover all that debt. So there isn't much to actually worry about. If you actually go into the calculation of how much is this going to get on a fair market value of the actual rental income that it can potentially have, then it's not really going to be an issue. You're actually servicing it. Now, versus if you were to buy a property yourself and put it under your name and you're going to live in it, right? You're going to pay $5,000-$6,000 out of your own pocket yourself. Now, that versus rental, right? It's kind of the same thing. If you're going to rent a property, you're going to be paying about the same amount of money, same amount of dollars every month anyway. So even if you're going to live in it, it's still a better option than just renting and paying somebody else the money and not giving yourself any ownership or capital growth in that sense. Because, properties across the board, I think, are either going to be positively geared, negative geared, or neutrally geared. And there's a lot of discussion around that. We're going to mention it probably on another podcast. What's the best option for you to go? But what that actually sustains is that there's the fact that you are able to, in either case, debt isn't something that we need to be afraid of, because if you do the math, it kind of works out to be the same. If not, puts you in a better position. I mean, we're now finding properties up in the 7 to 8% yield rate because their rents have gone up. And if you're, so on a $100,000 property, right? Not that that exists right now, but just doing the simple math, say $8,000 is your income, $5,500, dollars is your liability. That's what you got to pay to the banks. That means you're profiting $2,500 on a $100,000 property, which you would have forked out $20,000 to buy, right? You're borrowing $80,000. You forked out $20,000 to buy the property. So we look at what's called cash on cash return. So you're netting $2,500, let's say, all right? You're netting $2,500, and then you've got $20,000 in there, right? That you've invested. That's what? That's 12.5% return just on cash return, exactly. Which is crazy. I don't know too many stocks that are providing you a dividend of 12.5%, not even capital, just a dividend of 12.5% on that initial purchase price, regardless of the purchase price fluctuating. Initial purchase price, not to mention these properties are probably on its way up, and probably because they're probably going to be in low socioeconomic areas with crazy potential. I think that sparked some ideas in you. Share some of your thoughts with me.
Yeah, I've got a lot to say on this. I mean, firstly, if you put, for example, $10,000 in stocks wisely, and you achieve a 10% return on your investment, that's a fantastic outcome. I mean, that's great. And let's just say that's an average return over time, over a long period of time, 10%. That's a really good outcome in the world of stocks. However, yes, while it might be liquid, you might have access to that equity. It doesn't necessarily benefit your lifestyle, because you are funding this thing over time. You are waiting for a point in time where that stock portfolio can pay you a dividend to help you fund your lifestyle, and that can take decades. And yes, that's a good opportunity and a good outcome for a lot of people. But like we said, debt, this is where the difference between good debt and bad debt come in, because good debt is obviously when the result of you taking on that debt covers the debt itself, plus it puts money in your pocket. Yeah. That's why, you hear Warren Buffett say everything like that. They say, buy assets that put money in your pocket, not take money out of your pocket. And there are different ways you can use debt to buy property, some of which do take money out of your pocket. But other examples, they definitely put money in your pocket.
Exactly right. I mean, but the thing is, I don't think the median is at zero. That's the thing. So it's not like if you fall on one side of the median, you're going to make money. On the other side, you're going to lose money. I think the median is positive over property. We're going to look at some graphs in a minute. But overall, the median is very positive, which means that there's going to be a very high likelihood that we're going to be looking at a scenario where you buy property as somebody in their 20s, and you're going to be better off in your 30s, 40s, 50s until you retire.
So like you could throw a dart at a dartboard almost and have a positive outcome with property.
Exactly right.
But then you can also stack the odds in your favor and get even better results.
By being educated, and that's why people subscribe to Young Money Hackers, isn't that right?
That's exactly right. That's exactly what we're here to do. We're here to put you ahead of the curve.
Exactly right. So, okay, well then, what's property been doing over the last 30 years? So we're going to look at this graph over here, because people are also wanting to know. Like we're in a recession right now, yeah, which I think is super exciting, because that means you get to make some dosh when around recessions and things like that, which I think is really great. But what is actually happening right now? And that's what we want to have a look at. So over the last 30 years, right? This is the graph that we were able to find just using a bit of internet research. And this is what we're looking at. So I think I was personally most interested in the GFC and the impact that it's had on GFC. And it's like a little tiny little nothing, isn't it? Right?
Yeah, it's barely recognizable.
In the grand scheme of things, you zoom out and it's just like, wow. And in fact, I would have looked at that and go, wow, just after COVID would have been, not COVID, just after GFC would have been a fantastic time to have invested. And of course, I was only like 12 years old then. So, what do I know? But like, yeah.
Exactly. Yeah,
But I'm somebody that obviously has taken advantage of the post-COVID sort of investment cycle as well. So COVID actually had a much bigger dip. And, what were people doing then? They were just even then people were still complaining that the properties were too expensive, I remember.
Yeah, they were. Yeah, 100%. There's opportunity in every single market cycle, but now that we've been able to look back and see what we saw then, now it's like, now is a good entry point, in my opinion. It's an opportunity to get potentially discounted property to then over time recover from that and see that capital growth and unlock those options in terms of refinancing and positive cash flow.
Yeah, that's right. And that's what we're looking at right now. Like, if you look at dwelling prices, value tier across Sydney, Melbourne, and Brisbane right now, and I don't think other cities will be that much different anyway, we are actually in a dip. And we're actually in a dip on its way to recovery, which is actually quite exciting to see. The three lines you're looking at is obviously high, mid, and low tier properties. As you can see, the low tier properties have a much smoother line, which means that there's less volatility, which I think a lot of our listeners will be making an entry into. Or you might not. I mean, you might be wanting to go for the high tier property as well. But right now, it's actually a great time for whether you go for low, mid, or high tier. As an investment, your properties are going to do probably well. Sydney is obviously a bit of a leader, like a leading indicator of the market. It peaks first before. So look at Brisbane. It peaks a little bit after Sydney, right? And Sydney picks up a little bit earlier than every other city as well. So the fact that Sydney is picking up here, Melbourne and Brisbane are only going to follow. If this isn't an open book test, I don't know what is. Seriously.
Yeah, exactly. And just for people watching HD, what do you mean by low, mid, and high tier?
Yeah, right.
Can you
so
give a little bit more context?
So with low tier property, they tend to be in like a low socioeconomic locations. They're a bit further away from town. I wouldn't consider them rural or regional, but it's definitely within your metro regions. Their yields, their rental yields tend to be a little bit higher than your mid to high tier properties. And then obviously high tier properties are your mansions, right? They usually have upwards of 5 or 6 bedrooms. They come with a pool, a tennis court, all that kind of fancy stuff. They have shown to peak the most at the good times and drop the most at the bad times, right? They're one of the most volatile assets. Obviously, the entry price is going to be harder, but there is a lot of capital growth in that one. The tough part about, however, investing into top tier property is that it's going to be you're going to have very low rental returns if you treat it as an investment. So those are going to be your struggle points, and you're going to be out of pocket cash flow wise. Obviously, overall, if you have a big mansion, it's going to obviously put money in the pocket over a long period of time, but there's going to be a fair few storms that are going to be slightly harder to weather, much harder to weather, I would argue, than your mid to low tier properties as well. Mid tier properties, I would say that's where the I guess biggest bang for your buck is for, I think, your property hacking people out there. So you go into a mid-range suburb, you buy like a really rundown home on like a medium level sort of average Joe sort of working class sort of street or region, and then go, we're gonna build it, put a new bathroom, do a reno on there, and then it's going to probably have the best jump and the most marketable and the most saleable I guess outcome for that property. So that's how I would differentiate the strategies across the 3 tiers. What are your thoughts on this?
Yeah, I mean, I think that you're exactly like, that's a really good explanation. So like high tier property it's great because you have control over a larger asset, so you can experience a high, like obviously 10% growth on a larger asset is going to give you a lot more of a gain. However, like you said, the rental yield just isn't there with those larger properties. More exposure to like smaller properties, you still get effectively a similar growth curve as we just went through, but you get that higher
yields, right? Which is like a young person's best friend, because you need your cash flow. Cash flow is going to build up your deposit for the next house quicker, and B, it's going to increase what's called serviceability, right? Which is your ability to borrow more and more money to do each and new projects, which I think is really exciting. We've got some exciting stuff, developments in the marketplace these days, especially with high-end properties. If you go into like semi-regional, like not completely whoop-up styles, but like if it's sort of within like 40 minutes to an hour away from your metros, people like to have little getaways, and then these sort of acreages people buy with like a nice home, and then there's a whole bunch of land. And what they're doing is they're putting up like little cabins and like little sometimes like glamping canvas tents, and they're renting them out like crazy money, like $250, $300 a night. It has some crazy occupancy. Even through winter, people are, you know, wearing their parkas and having a little, wild and sort of glampy getaway out there. And like, I've seen these numbers and it's crazy. I mean, we are going to go through all of these different strategies, I think, as an episode by episode, as people come on board our podcast. They're going to realize that we are the real deal, because we're going to be actually talking about each of these investment and strategies and obviously these tactics. And we're going to back it up with real numbers and what we're able to achieve out there. And we ourselves are doing that. I mean, we're going to look at, Airbnbs and everything else as well. It's going to be heaps, like, it's going to be super exciting, this entire podcast. But that's another way I see high-end properties are finding some solution to its holding costs and all of its like unsustainable sort of I guess elements are becoming overcome by it. And that's what I love about property, man. Like, wouldn't you say that with properties, if you have control over one, you always find a way to make the highest and best use out of it, no matter what it is, that there are ways to solve these issues. You're never stuck with an asset and that's all it does for you. No. You can actually hack it, like the young money hackers that we are, right? To come up with the best returns possible to make it work for you. And that's what I love about property so much. What are your thoughts on this?
It's almost like a business. You know, you have control over this thing. You can do something with it, whether it be renovating it, putting, I don't know, a granny flat out the back, or just renting it out on a like Airbnb style thing, like you said. You can market it differently. There's so many options.
And these aren't harder to do. Like, if each of these options could put you $10,000, $20,000, $30,000 more in your pockets, and sometimes millions, right? Like, how hard do you have to work to make $30,000 in a daily job, like 9 to 5? Like, last time I checked, $30,000 is a good 3 months of work full time. Like, if you put in 3 months of work full time to doing something to your property, you would make way more than that money. That's for sure.
If you can learn how to put $1 into your property and get $2 back, that's a skill that you can develop
and repeatable as well, which means that is yet another type of leverage, right? It's not just involving banks. Leverage is using other resource to come up with a better outcome. And if you've got that resource, you can basically leverage on your gains on multiple systems, or on the same system, but on multiple case scenarios. And that's the beautiful thing about properties, that it's repeatable.
Yeah, 100%.
Let's dial it back though, to looking at and comparing properties and stocks, right? So if we look at, I think another metric that we found really interesting is we actually compare the stocks, right? The stock market with the property market. So if you look at the stock market, the dips are actually quite significant. So we're looking at almost 50% drop back in 2008, which I think is quite significant, and about 40% dip in the Corona boom. And there's another dip happening right now. And there was a big dip at the .com bubble as well. So if you look at the long game, I think the only time we've had a dip, we've had two significant dips. We've already established they're not that too significant anyway, but we've had these two dips where one and two of these dips were, I guess, were consistent with the stock market dip as well. But obviously those dips are far less. I mean, looking at the graph, we're looking at from $500,000 to about just north of $400,000. There's only a 20% drop on the property median house price. Whereas on the stocks, that is a whopping 50% drop, right? And that's all of your cash gone, because you probably didn't buy that on bank leverage. You bought it with all of your hard-earned cash. And we're looking at maybe $720,000 to about $620,000. That's around, I'd say, about 14% drop in the Corona boom, which has been a 34% drop in the stock market, which is quite crazy.
Yeah, and that would scare a lot of people. That would scare a lot of people out if they were investing in the stock market. They've just seen their net worth reduced by 40%.
Exactly right. And I think another thing to mention is that when this happens in the stock market, is that you're very, very tempted to pull out of the market, because it's so highly liquid. Everyone will just sell. Whereas in the property game, because of the dip, your property might not have been as saleable. And if that was the case, you might have had to been forced to hold it, which obviously in just a few good short years, you're looking pretty again. You know what I mean? Like, it's, you're so far ahead.
Yeah, exactly. And the other thing about property is there's not a big billboard with someone standing out the front of it saying your house is worth this, and
not $1 more.
Someone's telling you every single day that it's worth less and less. You don't even know. As far as you're concerned, the sun's shining and everything's
Everything
normal.
is normal. I mean, you might be paying a little bit more out of your pocket, but you just need to work a bit harder, right? But I think overall, the property has that magical ability to give you that discipline to be able to just keep going. Just don't stop. Just keep on going. Don't be stupid. Don't just jump out of the market. I mean, that's the thing about stock market as well. In the last 20 years, you would have bought stocks at any point in time, right? Like on average, I'm talking about this is SP 500, of course, the index.
Yeah.
And you would have made money.
Index fund, yeah.
You could have bought at the pico top of the pre-dot-com bubble or the pre-GFC, right? And you would have tripled your money right now, right? So investing as a general, I'm not saying like therefore stocks is terrible. You should never invest in them. No. You diversify everything, but even with stocks, just investing as a general is a much better practice than not doing it and like freaking out every single time something happens and selling out and just not staying in the market. It's not. They say it's not time. It's not timing the market. It's not timing the market. It's time in the market. So we got to actually follow and select assets where that's going to become sustainable and able to do. And you know what? And during these dumps, I wonder if holding on to stocks is much harder because there's no real money coming in through the door. Whereas properties would have still generated yields on this, rental income on this all throughout this period. So that being said, I think it's really good. And we were going to look at the comparison between the Australian market versus the US market, right? Australian market, there's something magical about the Australian market. I mean, we look at the Australian market, we've had smaller dips, but United States, we've had a dip from 150 index points to 93 index points. That's about a 30% drop, 33% drop. Obviously, still, again, less than the drop that we had in the GFC crisis. And that's what it was known for. But as you can see across the marketplace, the US prices didn't even dip when some of the dips were happening in the stock. So I think it's only about 1 or 2 dips out of the last 10 that the US prices actually dipped as well. And obviously they dipped a lot harder than Australian people did. But within about 80% of houses that were bought at the pico top of the global financial crisis were actually already becoming positive within 7 to 8 years as well. So that's the thing about properties is that during a recessionary period, it is a risk-off asset. So people want to flee from risk, so they go and buy property. During risk-on periods, they want to go and find more risk, and then they go and buy properties. It's both a risk-on and a risk-off asset, which is crazy, and it continues to generate income. And when the recovery comes in, it tends to recover the fastest out of any other industry in the marketplace as well, which I think is quite crazy. So, yeah, I mean, just looking at the marketplace as well. We're looking at highest 30-year growth rate is sitting at 5.9% per annum, 459% over the last 30 years, and then the lowest was at 4.8% per annum. I think it's pretty safe to say Australia has about a 5% yield rate, not a yield rate, 5% capital growth rate on an average yearly return. Yeah, average. You can definitely beat that. It's not hard to beat that. You and I are beating that like crazy every year, even as young investors right now. And then we're looking at the yield market over the last couple of years is sitting across the nation around about that 5%. So there's your sort of 10% both on cash, on income yield rate, and of course the capital rates as well. And we've just discussed how much we can leverage these gains just from a small amount of investment. So if it's like a 1-to-5 ratio, we're looking at upwards of 10 to 12% on your cash, which is quite crazy.
That's crazy. Exactly. It's like with the stock market. Again, you could get a 10% per annum year, and that might be fantastic. But then they might pay a 1% dividend or 1.5% dividend, sometimes 2% if you're lucky. And that's cute. It's nice. But when you're getting those rental checks, it's like the bank looks at that and they think, like that's sustainable income. We can lend you more money. Like we are going to give you more options to do more of this. And that's where the leverage comes.
That's right.
Yeah.
We are going to be debunking more of that is the mystery that is property. Young money hackers, thank you so much for tuning into today's video. I think we've had a very interesting and a vivid discussion around all of these topics. There is more to check out. Go reach out to us in our DMs and go in the description for more helpful links and resources. And we shall see you, pretty faces, next time. Peace.
Thanks, guys. Catch you later.